Money enters your life with excitement. The notification hits, the payment clears, the deal closes. For a moment you feel powerful, then weeks pass. The balance drops, the pressure returns, the anxiety resurfaces, and you ask yourself the same quiet question again. Why does money never stay with me? At first you blame the surface. Rent is high, taxes are unfair, the economy is unstable. Unexpected expenses keep appearing. All of that may be true, but there is a deeper pattern beneath it. Money does not leave randomly. It follows psychological laws. And if it keeps escaping you, the issue is rarely income. It is structure, it is identity, it is control. After 30, this becomes impossible to ignore. In your 20s, instability feels temporary. You tell yourself you're still figuring things out. But after 30, patterns harden, habits compound, financial behavior becomes predictable, and predictability without awareness becomes limitation. The first truth you must accept is uncomfortable. Money does not stay where there is no discipline. Discipline is not restriction. It is alignment between intention and behavior. You say you want wealth, but do your daily actions support wealth, or do they support comfort? Comfort is seductive. You work hard, you feel stressed, you reward yourself. Small upgrades, better food, better clothes, more experiences. Individually, they seem harmless. Collectively, they drain potential. The brain is wired for short-term reward. Dopamine spikes from spending are immediate. The satisfaction of investing is delayed. Most people never train themselves to enjoy delayed gratification, so money flows toward pleasure instead of power. After 30, if you do not rewire your reward system, your income will always serve your impulses, not your future. Another deeper layer. Money never stays because your identity rejects it. You may consciously want wealth, but subconsciously you may distrust it. If you grew up hearing that rich people are greedy, if you saw money create conflict, if you associate wealth with arrogance, then your nervous system will sabotage stability. You will unconsciously return to familiar territory. This is psychological self-regulation. Your mind prefers familiarity over improvement, even if familiarity is struggle. So when your bank account rises beyond your comfort level, tension increases. You feel exposed. You feel pressure. You spend to reduce that tension. And just like that, you're back where you feel normal. It's not logic, it's identity. After 30, if you do not upgrade your internal narrative, no external increase will stick. The second reason money never stays is lack of containment. Earning money is one skill. Keeping it is another. Growing it is a third. Most adults master the first and ignore the other two. You focus on income, but income without containment is like pouring water into a bucket with holes. Leaks are everywhere. Subscriptions you forgot. Habits you justify. Social spending you feel obligated to maintain. Family expectations you don't know how to refuse. You are not just spending money, you are leaking power. Money is stored energy. When you give it away without structure, you give away options. Options create leverage. Leverage creates freedom. Without savings, you cannot negotiate strongly. Without investments, you cannot multiply effort. Without reserves, you cannot survive disruption. So you remain dependent. Dependence weakens confidence. Weak confidence weakens negotiation. And weak negotiation limits income. It becomes a cycle. Another reason money escapes is emotional volatility. After 30, emotional stability is wealth protection. If your mood dictates your spending, you will never accumulate. Stress triggers indulgence. Loneliness triggers shopping. Celebration triggers excess. Insecurity triggers upgrades. Money becomes emotional anesthesia. But anesthesia does not heal wounds. It numbs them temporarily. If you don't build emotional awareness, your financial life will mirror your internal chaos. Stability outside requires stability inside. Now let's talk about power. Money does not respect need. It respects control. If you desperately need every paycheck, you negotiate from weakness. If one missed payment creates panic, you accept unfavorable terms. Desperation is visible. It leaks through tone and posture. People sense it, and when they sense it, they lower their offers. The calm person commands more. Because calm signals options. Options signal power, and power attracts opportunity. If money never stays, ask yourself, am I building options or am I increasing dependence? Lifestyle inflation is one of the most silent traps. You earn more, you upgrade immediately. Bigger apartment, better car, higher monthly obligations. Now your income increase becomes neutralized. Your baseline rises. Your stress remains. This is the golden cage. It looks like progress, but it locks you into higher pressure. After 30, you must delay upgrades. Let income rise before lifestyle does. Let investments grow before appearances change. True power is invisible at first. It grows quietly. Another reason money leaves is lack of clarity. Do you know your exact monthly expenses? Do you know your net worth? Do you know your savings rate? If not, you are operating blindly. Blindness invites leakage. Tracking is not obsession, it is awareness. Awareness creates control. Control creates growth. Without measurement, there is no strategy. And without strategy, money behaves randomly. But money is not random. It responds to direction. Money with a mission stays longer. Money without a mission disperses. If you don't assign every dollar a role, it will find one on its own. Usually consumption. After 30, consumption must be intentional, not emotional. Another psychological barrier, comparison. You see peers advancing, traveling, upgrading, posting visible success. You feel behind. And to close that emotional gap, you spend. But comparison-driven spending is ego defense, not strategy. You finance appearance to protect identity, but appearance does not compound. Assets do. Most people want to look rich. Few want to become structurally wealthy. Structural wealth requires patience. Patience feels slow, but slow and stable beats fast and fragile. There is also the issue of financial literacy. You may work hard, but if you do not understand investing, tax optimization, debt management, and asset allocation, you will lose momentum. Money uninvested loses value to inflation. Money mismanaged loses value to fees. Money poorly structured loses value to taxes. Ignorance is expensive. After 30, ignorance becomes choice. You must educate yourself, not casually, seriously. Read about compounding. Understand risk tolerance. Learn the difference between good debt and bad debt. If you don't understand the rules, you cannot win the game. And most people never study the game they play daily. Now consider this. Are you generous before you are stable? Helping others is admirable, but giving from weakness is unsustainable. If you sacrifice your financial foundation for temporary approval, you create long-term fragility. Approval does not pay future bills. Boundaries do. After 30, boundaries protect wealth. If you cannot say no to financial requests that harm your progress, you will remain stuck. Power requires selective generosity, not emotional obligation. Let's examine discipline again. Discipline is built through repetition, automatic transfers, scheduled investments, predefined limits. Remove decision-making where possible, because decision fatigue leads to impulsive behavior. When systems handle savings automatically, temptation decreases. Automation is silent strength. Manual discipline eventually weakens. Structure sustains. Another truth. You may fear investing because you fear loss, so you keep money idle. But idle money loses value quietly. Inflation erodes it. Opportunities pass. Confidence decreases. Risk avoidance feels safe. But stagnation is risk too. Calculated risk builds resilience. After 30, you must differentiate between reckless gambling and strategic investing. Risk is necessary, but it must be educated. Now let's talk about scarcity mindset. If you grew up with financial instability, holding money might feel uncomfortable. Spending feels relieving, because spending proves you have it. Saving feels like deprivation. Investing feels uncertain. So you unconsciously sabotage accumulation. You maintain the identity of just enough, because more than enough feels foreign. Rewiring this requires awareness. You must sit with the discomfort of holding money. You must normalize seeing higher balances. You must teach your nervous system that stability is safe. Wealth is psychological safety built over time. Another pattern. Lack of long-term vision. If you do not know what you are building toward, discipline feels pointless. Why save? Why invest? Why sacrifice? Without vision, motivation fades. Define a number. Define a target age. Define a lifestyle based on assets, not income. Clarity fuels discipline. Discipline fuels growth. Growth fuels confidence. Confidence fuels opportunity. Everything is connected. Money never stays because you are reacting, not designing. Reaction is emotional. Design is strategic. When expenses arise, do you panic? Or do you refer to a system? When income increases, do you celebrate with spending? Or allocate intentionally? Systems remove chaos. Chaos destroys capital. After 30, your financial life must resemble architecture. Solid foundation, defined flows, reinforced walls, growth floors. Random behavior produces unstable structures. Unstable structures collapse under pressure. Pressure is inevitable. Economic downturns, health issues, market volatility. Without reserves, every shock feels catastrophic. With reserves, shocks become manageable. Money stays with those who prepare. Preparation is invisible discipline. No applause, no recognition, just quiet power. Finally, understand this. Money amplifies who you already are. If you are impulsive, more money makes you more impulsive. If you are disciplined, more money accelerates growth. So the question is not, why does money leave? The real question is, who am I when money enters? Until that answer changes, the pattern will repeat. And this is only the surface layer, because beneath habits and discipline lies something deeper. Your relationship with control, power, and self-worth. And that layer determines whether money becomes your servant or continues slipping through your hands. Now we go deeper. Because habits alone do not explain why money never stays with you, underneath the spending, underneath the lack of structure, underneath the emotional decisions, there is power, or the lack of it. Money does not remain where there is no control, and control begins in the mind. Most people think they have a money problem. In reality, they have a power problem. Power is the ability to choose long-term benefit over short-term relief. Power is the ability to delay gratification without resentment. Power is the ability to walk away from temptation. If you cannot control yourself, money will control you. And when money controls you, it never stays. Let's talk about self-worth. Many people unconsciously cap their income because of internal ceilings. If you believe you are worth $50,000 a year, you will unconsciously sabotage opportunities that push you beyond that. You will undercharge. You will hesitate in negotiations. You will accept less. And when money exceeds your comfort zone, you will correct it through spending. Because staying above your self-image creates psychological tension. After 30, you must audit your internal ceiling. Ask yourself, what income level feels normal to me? What net worth feels unrealistic? Why? Your answers reveal the boundaries of your identity. Wealth requires expansion of self-perception. If your mind cannot hold abundance, your bank account won't either. Another hidden layer is fear of responsibility. More money means more decisions, more responsibility, more expectations. Some people unconsciously avoid accumulation because they fear pressure. It feels safer to live paycheck to paycheck. There is no strategy required, no investment choices, no asset management, just survival. But survival keeps you small. Power requires responsibility. If you want money to stay, you must be willing to manage it intelligently. You must be willing to learn, to track, to adjust. Wealth is maintenance, not magic. Now let's examine social pressure. After 30, social comparison intensifies. You see peers buying homes, starting businesses, living visibly upgraded lives. You feel internal urgency, and urgency often leads to poor decisions. You rush into investments you don't understand. You finance purchases you cannot sustain. You chase returns without research, because you don't want to look behind. But wealth built from comparison is fragile. True wealth is personal. It aligns with your goals, not your timeline anxiety. If money never stays, examine how often your decisions are influenced by how others perceive you. Are you spending to belong, Are you investing to impress? Are you upgrading to silence insecurity? These motivations are emotional, not strategic, and emotional money never compounds. Another factor is lack of leverage. If your income depends solely on your time, you are structurally vulnerable. One disruption, one illness, one layoff, and stability collapses. Money stays with people who build leverage. Leverage through assets, through equity, through scalable skills, through ownership. Ownership is the key shift after 30. Not necessarily owning a business, but owning something that grows without constant labor. Investments, royalties, digital products, equity stakes. If every dollar you earn is immediately consumed, you remain in the effort cycle. Effort cycle equals exhaustion. Exhaustion equals impulsive behavior. Impulsive behavior equals financial regression. It's not about working harder, it's about working strategically. Now let's address negotiation. You may be losing money before you even receive it. Underpaid salaries, unnegotiated contracts, unchallenged fees. People who avoid negotiation leave thousands, sometimes millions, on the table over decades. Why? Fear of rejection, fear of conflict, fear of being seen as greedy. But negotiation is not greed, it is alignment. If you do not advocate for your value, the market assumes you are satisfied, and markets reward those who assert themselves. After 30, you must become comfortable asking for more, not emotionally, strategically. Research your value, present data, pause after your request. Silence is powerful. Most people talk themselves out of higher compensation because they cannot tolerate tension. Tolerate it. That tension is leverage forming. Another psychological leak is lack of patience. Compounding takes time, but humans crave acceleration, so they chase trends, speculative investments, quick return schemes, high-risk opportunities. Most wealth is built through boring consistency. Index funds, real estate held long-term, business equity grown slowly. But boredom is uncomfortable, so people sabotage stability seeking excitement. After 30, you must detach excitement from money. Money is a tool, not entertainment. If you seek thrill, seek it in controlled experiences, not in financial risk. Another hidden truth: money leaves because you do not protect it. Insurance gaps, lack of emergency funds, no diversification. One event wipes out years of effort. Protection is unglamorous, but protection preserves power. Think like a strategist. Before you expand, you fortify. Before you grow, you stabilize. Another dimension is health. If your body's exhausted, your decisions deteriorate. Poor sleep increases impulsivity. Stress reduces rational thinking. Burnout triggers reckless spending. Energy management is financial management. After 30, neglecting health becomes financially expensive. Now let's discuss focus. Many adults over 30 scatter their energy. Too many goals, too many side projects, too many distractions. Scattered focus equals diluted results. Diluted results equal inconsistent income. Inconsistent income increases anxiety. Anxiety increases impulsive spending. Concentrated effort produces predictable growth. Predictable growth produces confidence. Confidence produces discipline. Discipline preserves money. Everything is connected. Another key issue: lack of long-term planning. If you have no 5-year financial blueprint, you will default to short-term comfort. Write it down. Target net worth, target investment portfolio, target passive income. Reverse engineer the steps. When money has direction, it behaves differently. It becomes assigned. Purpose reduces leakage. Now we address a difficult truth. Some people fear wealth because it changes relationships. If you outgrow your environment financially, dynamics shift. Jealousy appears. Expectations increase. Isolation may occur. So unconsciously, you remain at a level that keeps everyone comfortable. Belonging feels safer than abundance. After 30, you must choose alignment over approval. Not everyone will grow with you, and that is acceptable. Another internal leak is guilt. Guilt for earning more than family. Guilt for saying no to financial requests. Guilt for prioritizing your investments. Guilt drains clarity. You hesitate. You second guess. You overgive. But wealth requires boundaries. Boundaries are not selfish. They are strategic. You cannot build a fortress while handing out bricks. Let's return to power. Money stays where there is structure. Structure requires systems, automatic investing, clear percentages, expense caps, quarterly reviews. Treat your finances like a business, because they are. Would you run a company without tracking revenue and expenses? Without forecasting growth? Without contingency plans? Yet many run their personal finances blindly. After 30, blindness is costly. Awareness is mandatory. Now consider risk tolerance. Do you know yours? Or do you react emotionally to market shifts? When investments drop, do you panic and sell? When markets rise, do you chase aggressively? Emotional investing erodes wealth. Strategic investing compounds it. Discipline in downturns creates advantage. Most people lose money because they cannot control fear. Fear causes selling low. Greed causes buying high. Mastering these emotions is financial maturity. Another layer is time perception. If you think short-term, you will spend short-term. If you think in decades, you invest in decades. Shift your perspective. Imagine yourself at 60. What would that version of you thank you for today? Another luxury purchase or a diversified portfolio? Perspective creates restraint. Restraint builds capital. Capital builds freedom. Now understand this deeply. Money is neutral. It amplifies structure. If your structure is chaotic, money amplifies chaos. If your structure is strategic, money amplifies growth. So the solution is not chasing more income blindly. It is strengthening structure first. Income without structure equals volatility. Structure without income equals stagnation. Both are required. Finally, accept personal responsibility, not blame. Responsibility. If money never stays, something in your behavior permits it. Identify the leak, close it, strengthen systems, upgrade identity, increase leverage, protect assets, practice patience, refine discipline. Money is not mysterious, it is responsive. Responsive to identity, responsive to structure, responsive to power. When you become the type of person who controls impulses, thinks long-term, negotiates assertively, invests consistently, and protects strategically, money stops slipping, it settles, it compounds, it multiplies, not because luck changed, but because you did. And once you master yourself, money has no reason to leave.